If your setups keep looking perfect and your account keeps shrinking, the problem isn't your strategy, it's your time frame. Most swing traders make every decision on a single chart, and they walk straight into trades that are perfect on the daily and disastrous on the weekly. Today we'll fix that with the framework professionals actually use: weekly bias, daily trigger, 4-hour entry. 3 timeframes, one decision, dramatically better odds. Here is the stack. The highest time frame, weekly, for a swing trader sets your bias. Is the trend up, down, or sideways? You only take trades that agree with that answer, full stop. The middle time frame, the daily, is where you find the actual setup, the pullback, the breakout, the pattern. And the lowest time frame, the 4-hour, is where you time your entry, the candle close, the trigger bar, the precise spot. Each time frame answers exactly one question, and you don't skip a step. Start at the top. On the weekly chart, you're answering one question: trend, range, or downtrend. A series of higher highs and higher lows with price above a rising 20 or 30-week moving average tells you the bias is up. That's your filter for everything else. From this moment until the weekly bias changes, you only take long setups. Short ideas, no matter how good they look on a lower time frame, get ignored, because shorting a stock in a weekly uptrend is fighting the entire market against you. Here's the principle that makes it click. The higher time frame owns direction. The lower time frame owns timing. You start at the top to decide what to trade, then drop down to decide when to trade it. Most traders do the opposite. They spot something exciting on the 4-hour and zoom out only to confirm. That's backwards, and it's how you talk yourself into bad trades. Now drop to the daily. The weekly setup, so you're hunting longs only. On the daily, you look for one of your repeatable setups: a pullback to a rising moving average, a flag, a successful retest of a breakout level. This is where the pattern earns its name. The daily candle that closes back above the moving average with structure intact is the trigger. You don't enter on the trigger candle itself, you mark the high of it, and that becomes the line you wait to break on the lower time frame. Now the trap, and it gets even disciplined traders. You decide you want to be long, so you flip through 5 time frames and cherry pick the ones that support your idea. That's not analysis, that's confirmation bias dressed up. The rule is simple: each time frame has exactly one job: weekly, bias; daily, setup; 4-hour, entry. If you find yourself adding a 4th chart because the first 3 didn't say what you wanted, the answer is no trade, not more charts. On a real chart, walk through it top down before every entry. Weekly, is the trend up? Daily, is there a clean setup against a level I can define? 4-hour, did the trigger candle close in my direction? If all 3 answer yes, you have a high conviction trade with a logical stop and a clear target. If anyone answers no, you pass. There's always another setup tomorrow. Build the habit of asking those 3 questions in that order, and your hit rate quietly improves without you changing a single indicator. So, 3 time frames, 3 jobs. The weekly owns your bias and tells you what direction you're allowed to trade. The daily owns the setup and gives you the trigger. The 4-hour times your entry. Skip a step or stack charts for confirmation, and you'll keep losing on perfect-looking trades. Do it in order, and you stop fighting the trend without knowing it. Subscribe for the full method and trade your own plan. Education, not financial advice.